Picture this. While the leaders of China and the United States were meeting behind closed doors in Malaysia, China quietly sold $4 billion of sovereign bonds in Hong Kong, but denominated in US dollars. That sounds boring at first. Governments sell debt all the time, but timing and currency matter. Doing this during a secretive high-level meeting was not just a funding move, it was a signal. Here's the simple idea I want you to carry forward. Money markets listen to actions, not speeches. When a big country like China chooses to borrow in dollars and the market pays close attention to the rate it gets, it's telling the world something about trust, safety, and where global capital might prefer to park. If investors rush to buy those bonds even at low rates, it shows confidence in China's credit, and that shifts the financial map. Think of it like two lifeboats in a storm. For decades, everyone believed the US lifeboat was the safest. Now imagine a second lifeboat, China's, that suddenly looks seaworthy to many passengers. Even if that second lifeboat only takes a slice of people, it changes who gets rescued and who controls the lifeboat deck. Before we dig deeper into China's move, we need to make sure the foundation is crystal clear. Sovereign bonds might sound complicated, but the idea is actually simple. It's just a country borrowing money from investors, the same way a person might take a loan from a bank. Here's the basic formula. If you borrow $100 and you agree to pay $5 in interest, the interest rate or yield is 5%. That yield is more than just math. It's a price tag on a nation's credibility. When yields are low, it means investors trust the borrower. They believe the country is safe and stable, so they're willing to lend money at lower returns. When yields rise, it means the opposite. Investors need extra reward because they see more risk. Now, here's why things get interesting. Most countries borrow in their own currency. The US issues its debt in dollars. Japan issues in yen, Europe in euros. But when a country borrows in another nation's currency, it usually signals weakness, like saying, we need foreign cash because we don't have enough of it. But China isn't short on dollars at all. It has a $50+ billion monthly trade surplus and more than $3 trillion in reserves. So issuing bonds in dollars isn't about needing money. It's about sending a message. And that message becomes clear when we look at how the market reacted. Now here's where the story takes a sharp turn. When China issued its $4 billion in US dollar bonds, something unexpected happened. Investors were willing to accept lower interest rates than what the US Treasury was offering at the same time. To understand why that's surprising, imagine two friends asking to borrow money. Friend A is known as ultra-safe. They always repay on time. Friend B is generally stable, but not traditionally seen as safer than A. Normally, you'd charge friend B a bit more interest than friend A, right? But in this case, investors gave China, or friend B, a better rate than the United States, or friend A. This tells us something huge. Global investors are signaling that lending to China, for this moment, feels just as safe or even safer than lending to the US, and it gets deeper. In the US, the Federal Reserve sets a federal funds rate range. The upper bound is the highest safe borrowing cost. The lower bound is the absolute minimum safe return. If China's bond yields fall near or below that lower bound, and investors still buy aggressively, it means two things. First, investors trust China enough to accept even less return. Second, they may see money parked inside the US as less attractive or less safe than before. In global finance, trust is everything. And this sudden shift sends a message the US can't ignore. China's becoming a genuine competitor for the world's safe haven money. For decades, the world has treated the United States like the ultimate financial shelter, a place where money runs for safety whenever something goes wrong. Wars, recessions, political chaos. No matter what was happening elsewhere, global investors usually stampeded straight into U.S. assets, especially U.S. Treasury bonds. This is what allowed the U.S. to borrow cheaply, print freely, and still remain trusted. It's like being the only bank in a town where everyone deposits money the moment they hear thunder. But China's bond issuance, and the market's strong reaction, hints at a new reality. There may now be a second bank in town. Here's why that matters. Whenever major geopolitical conflicts broke out in the past, a massive portion of global capital flowed straight into the U.S. For example, during a European conflict in the late 1990s, over $700 billion left Europe in a short period, almost all of it landing in the United States. That inflow helped fuel nearly 90 months of economic expansion. The U.S. benefited because it had no competition. If there was fear, panic, or uncertainty anywhere in the world, the U.S. became the default hiding place for money. But if international investors start viewing China as another trustworthy safe haven, even partially, then future capital flows won't all rush into the U.S. anymore. Some would split off toward China. Even if only 1/3 of that money goes to China instead of America, the U.S. would feel the impact immediately. Higher borrowing costs, less liquidity, reduced global leverage, and weaker ability to harvest capital during crises. In short, China isn't just borrowing money. It's quietly carving out space as a rival safe haven, something no country has been able to do at this scale in decades.